The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For investors around the globe, the question is, where exactly is the market bottom? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're walking you through the closing bell. What a move today. Insane. The last 12 hours have been totally crazy within the market. Here's where we sit right now. The S&P is just down by about 0.5%, but you need to look at an intraday move of the S&P futures to really understand the depths of the move that we've seen. You still have an elevated VIX now at 47, a 10-year yield selling off pretty aggressively, now up by 15 basis points, the biggest move since September of 2022, and the Bloomberg Dollar Index now up, but again, a very volatile move for all asset classes remain across the board.
Yeah, and we talk about that intraday move. We're right now sitting on the biggest intraday point swing in S&P 500 history. On a percentage basis, we're talking about an 8.5 percentage point seesaw from peak to trough, the second most volatile day since the tail end of the global financial crisis. And the day's not over. In fact, at one point, it looked like the cumulative 3-day drop in the S&P was not only going to surpass swoons during the pandemic, swoons during the GFC, and swoons during the dot-com bubble burst, but flirt with extremes only last seen in October 1987.
Disorderly is not that market prices go down. Disorderly is when markets stop functioning, where basically bid-ask spreads widen out, liquidity dries up completely. The kind of situation where you have, a true market event is like what happened following the Lehman failure in 2008, or what happened during 2020 with the Treasury dash for cash. The markets just stop working. That's when the Federal Reserve will intervene.
All right. Well, if that's when the Federal Reserve acts, traders might actually want to take note of that. Overnight, they briefly did price in 5 quarter-point Fed cuts by year end, and that's a huge turnaround from just 2 months ago when they were pricing in just 1. Of course, the bugaboo in thinking the Fed would even cut 5 times is that easing monetary policy when the economy is slowing. That makes sense. But cutting rates when inflation is spiking, not so much. And Dudley does expect a spike to 5% on an annualized basis within 6 months. And that's a big part of the reason why a lot of Wall Street strategists aren't ready to start talking about a bottom. Morgan Stanley's Mike Wilson in his weekly note saying valuations would offer better support closer to that 200-week moving average, which is 4,700. That would imply, Alex, a drop of at least 6% from where we're trading right now.
And if we close below 49.15, that would imply a bear market from those highs of February. Here's one chart that may signal maybe we have reached some kind of bottom. So this is the difference between the first month VIX contract and the second month. So it really shows the difference in high volatility in the current month. And if you look all the way back to 2008, this is one of those events. You have 2008, you have 2011, 15, 2020, and then you have 2025. So that could point, Romaine, to the fact that maybe we've seen the signs of capitulation, washout, cross-asset volatility really picking back up. We've seen that macro event. Think of it this way. The 5-day realized volatility is now 57%. 10-day was near 41%. That could be that sign we're looking for.
John Belton joins us right now, portfolio manager and managing director for growth portfolios over at Gabelli Funds. And John, that really is the question. We had that spike to 60 on the VIX when the futures reopened earlier today. Was that the capitulation, or should we still be looking for it?
I mean, I think, thanks for having me, first of all. I mean, I think the market doesn't bottom till earnings estimates bottom. And I think it's still unclear when that's going to happen. There's still a lot of uncertainty out there. There's been so much going on. I've had more anxiety in the market the last couple of days than I had watching the season finale of White Lotus last night. But yeah, as a starting point, I think when earnings estimates bottom, that's usually a good sign for fundamental investors to step in.
And we should just point out, we're nowhere near any sort of bottoming in those estimates yet. And obviously, once the earnings season kicks in, we have some people talking about this idea of an earnings contraction. Gina Martin Adams, who's our main equity strategist here, she's actually positing that idea. Not saying it's confirmed that that's going to happen, but she's saying that has to be considered.
Well, yeah, I think so. I think we can think about it from a micro standpoint and a macro standpoint. So at a micro level, I think what investors, analysts, the like have been doing the last couple of days is thinking about the tariff rates that have been announced, assuming they go through, which I think has to be the base case assumption now, given all the signaling we've gotten from the administration. What's the impact to company earnings from a bottoms-up standpoint? I think the companies that we own generally running through that exercise, we're thinking 5 to 15% more or less earnings impacts. Some is going to be shared with consumers, some is going to be shared with suppliers, but that's sort of a starting point. The second order is more macro. So what does higher prices mean for inflation? What does that do to demand? What does that do to GDP? And I think to your point, are we going to have an earnings recession this year? I think it's entirely possible. I think most macro strategists seem to be coalescing around flat to maybe slightly negative real GDP this year. Again, a lot is going to happen between now and the end of the year, but that is not an unreasonable starting point.
Does that estimate for earnings take into account reciprocal tariffs from other countries like the EU and China and Canada?
No, that is just first order what's been announced, and I think there's a lot more dominoes that need to fall. I think, first of all, how much of the pain is going to be shared with consumers and with suppliers? And then, to your point, what is going to be announced in response by some of our big trading partners? And I think, that is something that's much more difficult to handicap. That would be more a third order effect that I would think about of what is kind of future responses from trading partners, what changes in some, the geopolitical order could stem from this. I think there's a lot that needs to be sorted out. And that's part of what makes this such a difficult investing backdrop is you've got declining earnings expectations and you have a bunch of tail risk scenarios out there that you need to be contemplating.
You need a huge fan chart when it comes to earnings expectations going forward in these earnings. Are you buying the dip anywhere in your coverage?
Well, we're still thinking more about playing defense. I think the best offense is a good defense. That's our framework right now. Right now we're looking across our portfolio, trying to consolidate in our favorite names. I will say for longer term capital, there's some interesting opportunities that are starting to present themselves. I think we're starting to get to fundamental levels for some really high quality, durable compounder type names that we haven't had a chance to buy previously, or we've had difficulty adding to them previously that are starting to get to really interesting levels. So we're not quite there yet. We're focused more on defense, but at a certain point, I think it's going to be time to play offense again, and we'll see when that is.
I am curious, though, some of your holdings, and we've had you on to talk about, particularly with some of the big tech names, I am curious about their global exposure, because there's been a lot of talk that even if this trade war, whatever we want to call it, starts to settle down here, you clearly have an administration that wants to see, I guess, a more homegrown, if you will, economy. And yet you have some of these tech companies that are clearly positioned for a global economy, whether it's their supply chain or whether it's their customer base. And I do wonder how you invest going forward with the possibility that might have to be rethought.
I think it's case by case. Every company has different dynamics, but one point on this topic that is sort of a response to your earlier point, who knows what's going to happen in terms of foreign governments. How are they going to crack down on some of these U.S. companies, if at all? So I think there are unknowns out there that there could be just higher taxes of doing international business in this post-Trump tariff world. We'll have to see. But I think generally big tech companies as a starting point, they're not, by and large, not going to be as impacted mechanically by tariff rates. I think they are impacted by any sort of trade war. No one's a winner in a trade war. But these are generally high margin businesses. High margin businesses are going to do better than low margin. They have pricing power. Businesses with pricing power are going to do better than not. So by and large, I think they've also taken a lot of pain. They're trading at valuations that are lower than they've been in many, many years. So as a starting point, seems an okay sandbox to be playing in. But
what about tech spend? Like, does tech spend migrate to AI from cloud? Does it go to a different spot? Does it pull back altogether? Because that ripple effect could be brutal for the companies that you guys own.
I think it's more of a generally IT budgets are pausing right now, have the potential to pull back going forward. I actually think most of the public cloud companies, AI companies, they will continue to take share of that IT spend wallet. It's just the wallet could be pausing or shrinking this year, depending on the magnitude and duration of this trade war.
How much sleep are you getting, John?
Well, after White Lotus last night, not a lot.
Well, he's really touting that. All right, John, thanks a lot. John Belton, Portfolio Manager, Managing Director for Growth Portfolios at Gabelli Funds. We really appreciate that. So CEOs under pressure, global tariffs threaten to raise costs, squeeze profit margins, and ultimately boost inflation. Now joining us for a read on leadership and sentiment is Kevin Kajiwara, co-president of political risk advisory at Teneo. Kevin advises Fortune 100 CEOs and significant institutional investors on geopolitical and policy risk. You also probably haven't slept in a really long time based on these markets.
Alex, I haven't slept in 3 months now.
Yeah, no, fair enough.
Right, yeah.
So I'm a CEO and I'm getting ready to release earnings. And I'm calling you and I'm saying, what do I tell investors about the outlook for my earnings? What are you saying?
Well, you can imagine that Teneo is receiving a lot of incoming on this very point. Of course, the issue is how you were dealing with these. Also, how you're going to mitigate against them going forward. No matter how well you did in the last quarter, everything is about now how well you're positioned for the future. The challenge, of course, is that everybody's in a slightly different boat. I mean, John was just talking about some of his portfolio as an example, but the reality of it is what your international profile looks like, what your supply chain looks like, what your financial position and your wherewithal to be able to absorb some of the shock. We saw this news from Stellantis earlier today that they were going to inoculate some of their supply chain to a certain degree. So it's kind of all over the place, and has to be handled really on a bespoke basis, to be honest.
Well, I am curious about how they're going to handle the public messaging, particularly when it comes to their consumers, basically the people who are buying the end products. Because if we do see a spike in prices, we kind of know how this plays. It's not necessarily the blame is not necessarily always going to go to the White House. Some people are going to look at the companies and complain that, oh, you're gouging us or some other thing. So what's the approach they need to take with that in managing their own costs and managing the possibility they may not have a choice but to raise prices?
Well, yeah, you've named it, Romain, right? I mean, how that is going to be read is going to be somewhat determined by how much pricing flexibility the company is perceived to have, but also the product that they sell and what the elasticity of demand is in the wake of that. I also think that, CEOs need to be highly cognizant as well of how that message is received elsewhere. I mean, the CEO is going to say what they are going to say. That's going to be received by all the various stakeholders in very different ways, right? Whether it's your shareholder, your customer, your employees, your regulator, the White House, Beijing, Brussels. Everybody's going to hear through the lens with, the way that they listen to it. And, you've got kind of one opportunity to thread that needle, which is why it's really critical to calibrate that message.
This may be a question you can't answer, but earnings season is coming up, as Alex just alluded to. Is there sort of advice to these CEOs to maybe not say anything at all, or at least not to say anything beyond the most basic and necessary thing that you need to come across on that conference call or on their whatever interviews they're doing in the media?
I think, again, it's case-by-case basis, as we have already seen just today, really for the first time since the news came out last week. Certain CEOs really starting in the financial sector, but going elsewhere as well, starting to break out a little bit here and be a little bit more candid on what they think, the net impact is going to be on the economy, on the consumer, on earnings, and and the challenge that the Fed is going to have going forward.
We recently, Bloomberg published an article about how Apple might be moving some of their iPhone production to India, or really focus on that. Are your companies aggressively thinking about how to reshape their supply chain, and if so, how?
I think they're thinking about anything that they possibly can here up at the moment. But I think also they've got to consider, again, the volatility with which policymaking is currently being made and whether they're going to start to get some clarity on where things are going to go and if there are going to be any off-ramps to the current policy on tariffs. As an example, right? I mean, if you're thinking about building a new factory somewhere, factories get depreciated out over 20 years. What happens if the tariff regime changes significantly over 20 years, right? After the first round of Trump tariffs in the first administration that were then compounded, doubled down on, and continued by the Biden administration, you saw a lot of companies attempt to, say, decouple, as an example, from or de-risk from China and move to Vietnam. Look how hard Vietnam was hit with tariffs last week. That would lead you to consider maybe that's not the place to be. And then Vietnam says they want to cut tariffs to zero and wants to negotiate with the White House. That would stay your hand yet again. So the point is that change is expensive. It takes time.
Right. And
you can't undo these decisions.
So when does a pause in, say, spend become a non-existent spend? when you just not do anything?
Well, I mean, I think that's more or less what we're, more or less what we're seeing right now. And again, depending on, where you are, how sensitive the nature of your business is, how much substitutability there is in the marketplace, et cetera, is going to be determinative of how much flexibility you've got.
Do corporate executives, particularly the CEOs, do they feel like they have anyone in Washington who will listen to them?
I think they feel that they've got plenty of people in Washington who will listen to them. I think
anyone who's actually in a position to actually make real decisions.
I think that's the big question, right? And certainly, I think what they're still adjusting to is whether all of the assumptions that they made about the president and his reaction function to, say, the market, as an example, are the same as they expected coming out of the first administration.
Yeah.
But I do think that they are, look, they're definitely getting a hearing, not only in the White House, but in Congress, regulators, and the like.
I bring that up. I had a phone call on Saturday with the CEO of a major corporation. He talked about the speed of which all this came, and he was drawing parallels to the first Trump administration, how they went through kind of more standard review processes, putting things in the Federal Register, and that from the time that Trump started talking about tariffs this was on China, to the time that they were actually implemented was like 18 months. It was a long time. This has basically been a 10.5, 11-week process, more or less, assuming you just peg it to his inauguration. So they're saying that we don't even have time to go down to Washington and lobby for what we want. Or if we do, we basically got 48 hours to make our case, and that's it.
Well, I think that's absolutely right, Romain. And not only that, it is entirely possible that a new event that might not even be related to the tariffs, something in Russia, Ukraine, something in the South China Sea, something in the Middle East, any number of events could distract the White House, the markets, and companies alike. We know, as an example, that we've got must-pass legislation that is continuing to compound, and the clock is ticking.
All right, Kevin, got to leave it there. Kevin Kajiwara, a co-president of political risk advisory at Teneo. We want to take you to the White House now. President Trump is speaking at a news conference with Prime Minister of Israel, Benjamin Netanyahu.
Very much, and so we'll see how it all works out. But we had great discussions today, I think, on the obvious subject of Iran, and also the less obvious subject with respect to Israel, and that's trade. And I think the Prime Minister is going to tell you a little bit about trade and what they're doing for the United States. So I want to thank you all for being here. Thank you very much. And
thank you.
Benjamin, thank you very much.
Thank you, Mr. President. Thank you, Don. Thank you. Mr. President, I want to first thank you for inviting me again to the White House. You've been a remarkable friend of the State of Israel. You stand by us. You're standing with us. You are a great, great champion of our alliance. And you actually do the things that you say you do. And I think that people respect that enormously. I certainly do, and the people of Israel do. And I think the Jewish people do as well. We just saw your representative in the Department of Justice fighting anti-Semitism, standing up for Israel in international forums. I just want you to know from the heart, it's deeply, deeply appreciated. As you said, we had the opportunity to talk today about many subjects. First, if I can mention tariffs, it's a subject of some interest today. I can tell you that I said to the President a very simple thing. We will eliminate the trade deficit with the United States. We intend to do it very quickly. We think it's the right thing to do. And we're going to also eliminate trade barriers, a variety of trade barriers that have been put up unnecessarily. And I think Israel can serve as a model for many countries who ought to do the same. I recognize the position of the United States. It says, we're allowing other countries to put tariffs on us, but we don't put tariffs on them. And I'm a free trade champion, and free trade has to be fair trade. And I think that's basically the position that you have put forward, Mr. President. We are going to eliminate the tariffs, and rapidly. I had the opportunity to speak to Secretary Lutnick yesterday. We talked about how we could effect this quickly, and I hope to bring the solution very quickly. We're not talking about intentions. We're not talking about just words. We're talking about results. And those results are going to come. that's the first.
Thank you very much. It's very nice.
Thank you. Thank you.
Mr. President, what about the hostages deal?
Well,
What about the hostages?
Let him finish.
Didn't finish. I'm going to begin. We spoke about not only the hostages, but about Gaza. The hostages obviously is a human story of just unbearable agony. I speak to the families. I spoke to them yesterday. Spoke to another one when I was in Hungary before I came here. I speak to them every day. They're in agony. The hostages are in agony, and we want to get them all out. Steve Witkoff was President Trump's very able representative, helped us get a deal that got 25 out. We're working now on another deal that we hope will succeed. And we're committed to getting all the hostages out, but also eliminating the evil tyranny of Hamas in Gaza and enabling the people of Gaza to freely make a choice to go wherever they want. I mean, they should have that choice. And the president put forward a vision, a bold vision, which we discussed as well, including the countries that might be amenable and are amenable to accepting Palestinians of their free choice if they choose to go there. And I think that's the second thing that we discussed. But the hostages came right on top. We also discussed the situation in Syria. We've had neighborly relations with Turkey that have deteriorated, and we don't want to see Syria being used by anyone, including Turkey, as a base for attack in Israel. Turkey is a country that has a great relationship with the United States. The president has a relationship with the leader of Turkey. We discussed how we can avoid this conflict in a variety of ways, and I think we can't have a better interlocutor than the President of the United States for this purpose. And of course, we also discussed Iran. Look, we're both united in the goal that Iran does not ever get nuclear weapons. If it can be done diplomatically in a full way, the way it was done in Libya, I think that would be a good thing. But whatever happens, we have to make sure that Iran does not have nuclear weapons. That's the end of my speech.
Mr. President,
We're having direct talks with. Wait. We're having direct talks with Iran, and they've started. It'll go on Saturday. We have a very big meeting, and we'll see what can happen. And I think everybody agrees that doing a deal would be preferable to doing the obvious. And the obvious is not something that I want to be involved with, or frankly, that Israel wants to be involved with if they can avoid it. So we're going to see if we can avoid it. But it's getting to be very dangerous territory. And hopefully those talks will be successful. And I think it would be in Iran's best interest if they are successful. We hope that's going to happen. And we had just a lot of good talks on a lot of things. I appreciate very much what you said about the tariffs. We've been ripped off and taken advantage of by many countries over the years, and can't do it anymore. Just can't do it anymore. We can't be the stupid people anymore. And it's all because of the people that sat in the seat right here. Not your seat, but this seat. They allowed things to happen to our country that they shouldn't have allowed to happen on trade and other things, many other things. I mean, look at what's happened with our last president, where he allowed millions of people to come into our country with an open border. Who would want an open border? How stupid was that? But he allowed millions and millions of people, and of the millions, and I think it was 21 million people, but let's say 3 of them were serious criminals, serious murderers and drug dealers and gang members and people from jails. All the jails emptied out right into our country, right along the open border on Mexico, generally the Mexico. Okay, they came in from Canada too, by the way, a lot. But generally speaking, on the southern border. And what a shame it is that we are now working very hard to get them out, get the criminals out, get the murderers out, the drug dealers, the mentally insane, get them out. They dropped the mentally insane in our country too. And this was all done by the Biden administration. It's a disgrace that we have to work so hard. And then we have judges that try and protect these people, but they didn't protect us when the people were being let in. But to get them out is never easy with these people. So I think we're doing a great job. The border is the best it's ever been. Even as strong as it was. I had a great, solid quarter. I think it might even be tougher right now and stronger. So people are coming into our country, but they're coming in legally. We have a legal process, and we have that moving along properly, because we need people to come into our country, but we want people that can love our country and cherish our country. So that's where we are. And with that, any questions?
Mr. President, the European Union reaction to the markets today, and would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many, many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. There'll be fair deals. As you know, I spoke this morning with the Prime Minister of Japan, and we had a very good conversation. They're coming. And I said, one thing, you're going to have to open up your country, because we sold no cars, like 0 cars in Japan, and they sold millions of cars into our country. They don't really take our agriculture, a little bit of it just to keep us slightly happy, but they don't take what they're supposed to be taking. So we have a great relationship with Japan. We're going to keep it that way, but they're coming in to meet, and other countries are coming in. With China, as you know, against my statement, they put a 34% tariff on above what their ridiculous tariffs were already. And I said, if that tariff isn't removed by tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put on. So they've gone for years. They've become a rich country because of people, again, that were in the White House that allowed this to happen. Hundreds of billions of dollars a year they'd make on us on trade, and it shouldn't be that way. And I have a great relationship with President Xi. I hope it's going to stay that way. I have great respect for China. But they can't do this we're going to have one shot at this, and no other president's going to do this, what I'm doing. And I'll tell you what, it's an honor to do it, because we have been just destroyed, what they've done to our system. You know, we have $36 trillion of debt for a reason. And the reason is that people allowed it to get that way. So we'll be talking to China. We'll be talking to a lot of different countries. And I think, you know, if we can make a really fair deal and a good deal for the United States, not a good deal for others. This is America first. It's now America first. And we didn't put America first. We put America last. The people that were in the Oval Office put America last, and we're not going to stand for it. Yeah.
The U.S. in the talks with Iran.
2 questions. Do you expect any of these deals to be made before April 9th? And secondly, there have been some mixed messages from your administration. You're talking about negotiations, and yet others in your administration are saying that these tariffs are actually permanent. What is the action?
Well, they can both be true. There can be permanent tariffs, and there can also be negotiations, because there are things that we need beyond tariffs. We need open borders. You know, we almost had a deal with China where we're going to open up China. It was almost done. Some of you remember it during my first term, and it was very disappointing. We ended up making a great deal. $50 billion worth of product was sold. $50 billion. You'd like that in Israel. And I made that deal, but it wasn't the deal that I wanted. It was the deal that I wanted was that, plus they were going to open up China so that our companies could go into China and compete with other countries and China for for a large number of people. And at the very end, that deal was terminated, and we went to a piece of the deal. And so there are a lot of things outside of tariffs, but tariffs are very important. But there are a lot of things like opening up countries that were totally closed. China is essentially a closed country. In fact, it is a closed country. And what they do is they charge tariffs so that if you sell cars or if you sell anything, nobody's going to buy it because the price is out of control. But that's true with a lot of other countries also. So we're going to get fair deals and good deals with every country. And if we don't, we're going to have nothing to do with them. They're not going to be allowed to participate in the United States.
Mr. President,
relax, we have time. This gentleman is all day long.
Mr. President, thank you for the chance. Many of Palestinian Americans who voted for you and not for Biden because you've promised them to end the war in Gaza.
Very honored by that vote, too.
The war is still going on and there's no hostage deal. Do you have any update on that?
Well, I'd like to see the war stop, and I think the war will stop at some point that won't be in the too distant future. Right now we have a problem with hostages. We're trying to get the hostages out. We got quite a few of them out, but it's a long process. It shouldn't be that long. We have a big problem that we've done. I think I'll ask Pete to maybe talk about it for a second, because a lot of people are asking. The Houthis, we've been very tough and very successful militarily. We've really damaged them badly. These were people shooting down ships and other things, by the way, flying objects like airplanes. And we've put a major hurt on the Houthis, which nobody's been able to do. We've really hit them hard, and they know it, and they don't know what to do. And it's every night, night after night. And we've gotten many of their leaders and their experts. They're experts on missiles. I mean, they actually make missiles. Nobody thought that. But they make missiles. They're highly sophisticated, and they're very tough. But they've been very badly damaged. Nobody else was able to do that but us. Pete, you want to discuss that, please?
Yes, sir. It's been a bad 3 weeks for the Houthis, and it's about to get worse. It's been a devastating campaign, whether it's underground facilities, weapons manufacturing, bunkers, troops in the open, air defense assets. We are not going to relent. And it's only to get more unrelenting until the Houthis declare they will stop shooting at our ships. And we've been very clear at the Iranians as well. They should not continue to provide support to the Houthis, and that message has been made very clear. So we have a lot more options and a lot more pressure to apply, and we know, because we see the reports, how devastating this campaign has been in them, and we will not relent.
We have a great military. There's no military like our military. And despite Biden having given a lot, but nevertheless a pretty small piece, but it was a lot of our military away in Afghanistan, and one of the dumbest situations, I think, and maybe the most embarrassing situation we've ever been involved in, that short period of time in Afghanistan. What a disgrace that was, but left a lot of our military behind, left. You see them in their annual parades where they're parading trucks that are armor plated and different things that they can't. But it's many billions of dollars we left behind. But despite that, we have a tremendous military. That was a very small portion because we rebuilt the military during my first term. And we have great things happening with our military. We also essentially approved a budget, which is in the facility, you'll like to hear this, of $1 trillion, $1 trillion, and nobody's seen anything like it. We have to build our military, and we're very cost conscious, but the military is something that we have to build, and we have to be strong because you got a lot of bad forces out there now. So we're going to be approving a budget, and I'm proud to say, actually, the biggest one we've ever done for the military. We're cutting other things that were under DOGE, but under a lot of other. When you look at a woman getting $2 billion for environmental, and it had nothing to do with environmental, and they had $100 in the bank, and they give her $2 billion. Many of those cases, all that stuff is going to be cut out. But we are getting a very, very powerful military. We have things under order now, the likes of which we've never had before. We've never had the kind of aircraft, the kind of missiles, anything that we have ordered. And it's in many ways too bad that we have to do it, because hopefully we're not going to have to use it. But the military is very, very powerful, and it's going to remain that way.
How do you, Mr. President, deal, please?
Yes, please.
Thank you, Mr. President. I want to ask you about Iran, because this is the first time we hear that the U.S. is having a direct contact with the Iranians. Is it possible to give us some more information at what level the U.S. is represented?
High level, very high level.
And
yeah. We're dealing with the Iranians. We have a very big meeting on Saturday, and we're dealing with them directly. You know, a lot of people say, oh, maybe you're going through surrogates, or you're not dealing directly, you're dealing through other countries. No, we're dealing with them directly, and maybe a deal is going to be made. That would be great. It'll be really great for Iran, I can tell you that. But hopefully, we're not going to have to get into that. We are meeting very importantly on Saturday at almost the highest level, and we'll see how it works out. Please.
How do you ensure, Mr. President, that these tariffs don't drive U.S. trading partners into the hands of the Chinese?
I'm not worried about it. I'm not worried about it. If they want to be in the hands of the U.S., they don't want to be in the hands of the Chinese. And the Chinese have turned out to be really not very good at that. People that are with us, they're with us. But we cannot be taken advantage of any longer. I used to watch these deals for years. I've been talking about it for years. I've been talking about it for 35 years, how our country is being ripped off. I mean, 30 years ago it was Japan, then it was something else, then it was another group, then it was China. China's doing the best job of it, frankly. And it's just not going to happen, not going to happen.
Mr. President, you've said it may
take. The EU has said that they have offered 0 for 0 tariffs on cars and industrial goods. Is that not enough?
Well, the EU, no, it's not. The EU has been very tough over the years. I always say it was formed to really do damage to the United States in trade. That's the reason it was formed. It was formed with all of the countries from Europe, I guess most of them, not all of them, but most of them. And they formed together to create a little bit of a monopoly situation, to create a unified force against the United States for trade. So they have NATO, which is largely the same countries, and they took advantage of us dollar-wise and militarily until I got there. I was able to get $600 billion from NATO, where they paid NATO because most of these nations weren't even paying. We were paying for NATO. So we're paying them to guard them militarily, and they're screwing us on trade. So that's not a good combination. So now it's really turned around. It's the opposite. And the European Union's been very bad to us. They don't take our cars, like Japan in that sense. They don't take our agricultural product. They don't take anything practically. And yet they send millions of cars in a year, Mercedes-Benz, Volkswagen, BMWs. They're sending millions and millions of cars into the U.S., but we don't have a car that's been sold to the European Union or other places, but let's go for the European Union. And it's not going to be that way. It's got to be fair and reciprocal. It's got to be fair. It's not fair. We have a deficit with the European Union of $350 billion. And it's going to disappear fast. And one of the reasons and one of the ways that that can disappear easily and quickly is they're going to have to buy our energy from us because they need it. They're going to have to buy it from us. They can buy it. We can knock off $350 billion in 1 week. They have to buy and commit to buy a like amount of energy. And we have that. We have more energy than any country in the world. I don't know if you know that. He knows everything, but the one thing he may not know, we have more energy than any country in the world. We have more of every kind of energy, every form of energy, from oil and gas to coal. And people talk about, I call it beautiful, clean coal. As you know, Germany is opening up a coal plant a week. They tried the windmills and it didn't work. They tried all the other solutions and they were ready to go out of business. Now they're doing a coal plant a week. China is now up to 2 coal plants. They're opening 2 major coal plants every single week in China, all over China, and then we're not allowed to use coal. Well, we have clean, beautiful coal more than anybody else. We have oil and gas more than anybody else. We have the most energy of any country in the world, including Saudi Arabia, including everybody, by a lot. And I took it to number 1. We were number 3, and I took it to number 1 during my administration. And the reason that we were hurt so badly and the reason that we went into such incredible inflation during Biden is energy. It was also their bad spending, but energy, because they played around with this incredible thing that we had built, this administration had built, and the energy costs went through the roof. And when that went up, everything else followed. Now, if you look at what's happening, you got to see this today. I said, we're going to try and get groceries down, right? An old-fashioned term, but a beautiful term. Eggs. So when I got in, the press went absolutely crazy the first week. They said, eggs have quadrupled in price. I said, I just got here. Tell me about it. And Brooke Rollins and our team did a great job, and eggs are down now 79%, and they're all over the place. And this was a problem that somebody else would have taken a long time to cure. We have energy is down. We have interest rates are down. We have groceries, meaning food is down. We have everything is down at levels that nobody ever thought possible. Energy looks like it's going to be in the $2.50 a gallon range and maybe below that for a car. So for gasoline. So we're really doing amazing. I mean, we're cutting prices because prices got so high people couldn't live. I mean, the prices for groceries, the prices for standard groceries, standard things were going through the roof. They couldn't live. And now those prices are coming down. So call them groceries, but that's down, energy's down, and interest rates are down. Everything's down. And the interest rates, the beauty there is when we refinance debt, you know, debt's become such a big factor in this country. We're going to start paying debt off with tariffs and other things. But it's such a big factor because the interest rate's so high. Well, now that's coming way down. So our budget's going to look a lot better because interest costs are way down. And I guess I've done that.
Many Israelis are watching you now on live show.
Good.
What is your specific way of getting the hostages out from the horrific captivity?
We are trying very hard to get the hostages out. We're looking at another ceasefire. We'll see what happens. But we want to get the hostages out. The Israeli people want the hostages out more than anything. They want the hostages out. This man is working very hard with us to do that. I mean, I don't know. I hope he's being appreciated because he's been a great leader. He's working very, very hard on the hostages and many other things. And there are plenty of things you have to work on. It's a tough place in the world.
I have a good partner.
Yeah, you do have a good partner, and so do we. We're working very hard on the hostages.
If you're going to negotiate a new deal with Iran, can you elaborate how it's going to be more effective than the JCPOA?
Well, I can't really say that, but I think it'll be different and maybe a lot stronger. But they were so happy when we made that first deal because we did get a lot out. You know, I had people right in this office, this beautiful Oval Office. They came in, 10 people, hostages, you know that. And I said to them, so how was it? And the stories they told me, I mean, as an example, I said to them, was there any sign of love? You were there, 10 people. It's only 10, but it's pretty representative. Did the Hamas show any signs of, like, help or liking you? Did they wink at you? Did they give you a piece of bread extra? Did they give you a meal on the side, like, you know, you think of doing? Like what happened in Germany, what happened elsewhere. People would try and help people that were in unbelievable distress. They said no. I said, all of them. I said, did they ever wink at you like, you'll be okay? You're going to be okay? No, they didn't do that. They'd slap us. The hatred is unbelievable. And the lives, you know, they lived in a pipe, not really a tunnel, it was a pipe. And they always thought they were suffocating. They were going to suffocate. And then they'd open up the pipe, and it was like 3.5 feet high. This isn't, you know, we hear tunnels bad, but pipes are worse. And the stories I heard were incredible. But I just said, was there any sign of potential love or affection? And there were none whatsoever. It was amazing to me. There was nothing like, here, take this, it's a little extra meal or something. They lived like hell. I don't know. They seemed to be, they were amazing to me because they seemed to be pretty normal. They weren't scarred, but I guarantee underneath they have to be scarred. And one was there for 356 days. Another was there for about 180 days, you know, a long time. These are people that have been really, really horribly treated. I've never seen anything like it, actually. I was very surprised to hear the answer.
Thank you, Mr. President. Are there 2 or 3 countries that are on your list that you feel are farther along in getting their tariffs lowered?
I think there are many that want to get rid of tariffs right now. European Union, I mean, as badly as they've treated us, they've brought their car tariffs essentially off. I guess they brought it down to 2.5, and I hear maybe to nothing. But it's not only tariffs, it's non-monetary tariffs. It's tariffs where they put things on that make it impossible for you to sell a car. It's not a money thing. They make it so difficult, the standards and the tests. They drop a bowling ball on the top of your car from 20 feet up in the air, and if there's a little dent, They say, no, I'm sorry, your car doesn't qualify. When the same car from Germany or anything would dent likewise. Unless you're going to have an army tank, it's going to dent. So they come up with rules and regulations that are just designed for one reason, that you can't sell your product in those countries. And we're not going to let that happen. Those are called non-monetary barriers. They make barriers that are so tough that it's impossible to qualify. So tariffs are a big part of it, but there's another big part of it, and that's barriers. They also do something else. They manipulate their currency, and they drive it down. They want to have low currencies. You know, it sounds better to have a high currency, a strong dollar or whatever, but they bring their currency down, and when it competes with our currency, it's very hard to sell a tractor. It's very hard to sell product, because their currency is low and ours is much higher relatively. And so it makes it very hard. I speak to a lot of companies that do business, tractor companies, and they say it's so hard to sell because what they've done is they've lowered the yen, or they've lowered the yuan, or they've lowered their currency, so that it's very hard to compete. We don't want that either. So we have a lot of things that we're talking about, but we're going to fix it properly, and it's going to be fair to everybody. And in the end, I think we're going to have a world that does a lot better, you know. But they have to respect the United States, and nobody but me would do this. Nobody but me would do this. You know, it would be nice to serve, a nice, easy term. But we have an opportunity to change the fabric of our country. We have an opportunity to reset the table on trade. We lose billions of dollars. We lose close to $2 trillion a year on trade. We lose $1 trillion a year to China. $1 trillion. We lose hundreds of billions of dollars a year on trade to China. We lose hundreds of billions of dollars overall, probably close to $2 trillion. Why would we do that? Number one, why would we do that? And then you have to say, is it sustainable? Then you hear about all of the people that say, well, deficits. If we have a deficit with the country, or if the country has a big surplus with us, like China has a massive surplus that they take and they spend on their military. Well, we don't want that. I don't want them to take $500, $600 billion a year and spend it on their military. I don't want them spending money on their military. And I shouldn't have to spend money. We shouldn't have to spend it either. Because, you know, hopefully, and I said this to President Xi, hopefully it's money that we're never going to use. In other words, because we're not going to use those incredible weapons that we have and that they have. We don't want that. So it's going to be very interesting. It's the only chance our country will have to reset the table. Because no other president would be willing to do what I'm doing or to even go through it. Now, I don't mind going through it because I see a beautiful picture at the end. But we are making tremendous progress with a lot of countries, and the countries that really took advantage of us are now saying, please negotiate. You know why? Because they're getting beaten badly because of what's happening. They're getting beaten badly. They're being devalued as countries. But it's the only chance we're going to have to reset the table on trade. And when we do, we're going to come out unbelievably well. We're going to have a strong country economically again. And we're going to have those factories that are empty all over the United States. We've lost 90,000 plants and factories. Think of this, 90,000, you wouldn't think it's possible, 90,000 plants and factories since NAFTA, which was, by the way, the worst trade deal ever developed, ever had by any country anywhere, NAFTA. And I terminated NAFTA. Everybody said it would be impossible. And I terminated it through Congress. We terminated it. You had to get it through Congress. It was a trap. It was a horrible thing. And we got it done. And we went to the USMCA, which was much better. The problem is they cheat. They cheat like crazy. Canada cheats. Mexico cheats. Just one of those things. But we are resetting a table, and we're going to have great trade. And we're going to have a very strong country. Our country is going to be at a level that has maybe never been, or maybe, you know, our country was the strongest, believe it or not, from 1870 to 1913. You know why? It was all tariff-based. We had no income tax. Then in 1913, some genius came up with the idea of let's charge the people of our country, not foreign countries that are ripping off our country. And the country was never that kind of wealth. We had so much wealth, we didn't know what to do with our money. We had meetings, we had committees, and these committees worked tirelessly to study one subject. We have so much money. What are we going to do with it? Who are we going to give it to? And I hope we're going to be in that position again.
Mr. President, do you plan to reduce the tariffs that your government put on Israeli goods, 17%?
On where?
On Israeli goods, the 17%. Do you plan
Well,
to
we're
reduce
talking about a whole new trade. Maybe not. Maybe not. Don't forget, we help Israel a lot. You know, we give Israel $4 billion a year. That's a lot. Congratulations, by the way. That's pretty good. But we give Israel billions of dollars a year. Billions. It's one of the highest of, and we give a lot of countries money. You wouldn't believe if I said we give Afghanistan a lot of money, didn't it? Because that was a Biden deal, another Biden deal. Not only did he embarrass us with that, but they give them billions of dollars, Afghanistan, right? So, but no, we take good care of our friends, and we don't take care of our enemies. We're not taking care of our enemies anymore, but we do take care of our friends.
Thanks for reference to the Times of Israel. The IDF is fighting again in the Gaza Strip. I myself might be called up in a month. Do you think that's the way to pressure Hamas to get to a deal? And do you think blocking humanitarian aid is also an effective pressure tactic?
Well, you know how I feel about the Gaza Strip. I think it's an incredible piece of important real estate, and I think it's something that we would be involved in, but you know, having a peace force like the United States there, controlling and owning the Gaza Strip would be a good thing. Because right now, all it is for years and years, all I hear about is killing and Hamas and problems. And if you take the people, the Palestinians, and move them around to different countries, and you have plenty of countries that will do that, and you really have a freedom zone. You call it the freedom zone, a free zone, a zone where people aren't going to be killed every day. That's a hell of a place. It's you know what I call it, a great location that nobody wants to live in, because they really don't. And when they have good living, real living, where Hamas and all of the problems they have, the level of death on the Gaza Strip is just incredible. And I've said it. I don't understand why Israel ever gave it up. Israel owned it. It wasn't this man, so I can say it. He wouldn't have given it up. I know him very well. There's no way. They took oceanfront property and they gave it to people for peace. How did that work out? Not good.
Is the immigration, sorry, Mr. President, is the immigration plan still on the agenda?
Which immigration?
From Gaza. From Gaza.
All it is a concept that I had that I think is good, and now people are copying it. You know, maybe you want to tell. People are talking about the Trump plan. Gee, why don't we do that? Would you like to answer that question?
I think what the president talked about is, first of all, to give people a choice. You know, Gazans were closed in. And every other place, including in arenas of battle, I mean, whether it's Ukraine or Syria or any other place, people could leave. Gaza was the only place where they locked them in. We didn't lock them in. They were locked in. And what is wrong with giving people a choice? Now, we've been talking, including over lunch, about some countries, I won't go into them right now, that are saying, you know, if Gazans want to leave, we want to take them in. And I think this is the right thing to do. If you give, you know, it's going to take years to rebuild Gaza. In the meantime, people can have an option. The president has a vision. Countries are responding to that vision. We're working on it. I hope we'll have good news for you.
I will say people really do love that vision. It's a long-term vision, but so importantly is to have that be a safe field, because you're right smack in the middle of the Middle East. You're right along Israel. It should have never, ever been given away. It shouldn't have been given away by Israel. I don't know why they did it. I mean, I do know why, because they were promised peace, but that didn't work out too well, because it's one of the most dangerous pieces of land anywhere in the world. Gaza is one of the most dangerous places in the world. So they gave it away for a good intention, and it didn't work out that way. And a lot of people like my concept, but you know, there are other concepts that I like too. And there are some concepts I don't like. You know what I don't like? The way it is now. Because right now it's a dangerous death trap, Gaza.
Thank you, sir. Can you talk a little bit about your potential meeting with Vladimir Putin? Do you still plan to meet with him? Could that happen in Saudi Arabia? And maybe you could elaborate as well a little bit on not providing tariffs on Russia, sir.
So the reason we're not talking about tariffs with Russia is because we're not doing business essentially with Russia because they're in a war. And I'm not happy about what's going on with the bombing because they're bombing like crazy right now. They're bombing. I don't know what's happening there. That's not a good situation. So we're meeting with Russia. We're meeting with Ukraine. And we're getting sort of close, but I'm not happy with all the bombing that's going on the last week or so. Horrible. It's a horrible thing. It's a horrible thing.
That was President Trump speaking with Israel's Prime Minister Benjamin Netanyahu in the Oval Office at the White House in a wide-ranging press conference there. Part of the conversation centered around Iran. President Trump saying that there will be direct talks and a big talk on Saturday at the very high levels. This is very different from what Iran has said in the past, that has repeatedly rebuffed calls for those direct negotiations, and taking a lot of a firm stance there on tariffs as well, saying that the EU is not doing enough, that China's a closed country. He wants fair deals and not looking at any sort of 90-day delay or potential pause for tariffs. Romaine, it feels like you got to take him at his word at this point. Tariffs are here to stay for a bit, at least.
And we did not really see a huge move in the market based on any of those comments. We continue to see the oscillations between gains and losses well off the lows of the day, but well off the highs of the day as well. The S&P down about 0.2%. The Russell 2000 and some of those more economically sensitive areas of the market, they're down the most here on the day. And, you know, Alex, every morning I come in and I take a look at my inbox and I look to see what analysts had to say overnight here with their upgrades and downgrades. And today I had a flood of notes in my inbox. Most of them were to the downside, and that included General Motors. Those shares have been under pressure all day. Bernstein actually downgraded the automaker to underperform from market perform, citing the impact of tariffs and set a price target of $35, which implies about a 21% downside from where that stock closed on Friday. Pleased to say that the man behind that note joins us right now. Daniel Roeska is managing director and senior analyst over at Bernstein. And Daniel, the big question right now here is for an automaker that's being hit from all sides when it comes to these tariffs, potentially being hit from potential economic weakness, as well as export markets that, I don't know, potentially with the retaliation from other countries could start to close up. Is there any hope that you could actually maybe end up upgrading this stock at some point this year?
Well, we phrased up in the downside. The downside is very clearly we did not choose the most punitive scenario. We took a fairly lenient interpretation of the tariffs that could be worse. The upside is if the administration decides to turn around, they would need to remove the tariffs on automotive, and that would give a substantial upside to all the auto stocks.
Do you have any hope that that's going to happen?
When we started this year in January, we always said we need to call it like it is. We need to look what's written, what's on the ground, what's happening. And the tariffs started this week. Parts tariffs are starting end of May, beginning of May. And so we said, look, we don't have a choice. We need to look at the facts as they are, and that is a downgrade of GM.
We heard in that recent press conference that President Trump was talking about the EU treating them very badly, that we don't sell any cars to the EU. Is that true?
It's not entirely true. We've got Ford with some cars left in the European Union, so there is trade going on, but a lot of them are manufactured in Europe then.
Okay, so that supply chain is a little bit different. Is there a scenario where this is good for car makers, that inventory gets weeded out, that they actually wind up having weird pricing power? Like the supply chain issue we saw back in 2020, automakers crushed it.
No.
Why? Why is this different?
And the difference really is that we're introducing a cost impact into the industry. Basically, you're faced with add 25% of cost to your cars or figure out a way to make that slightly less. But even if you have a car in Mexico that needs to pay tariffs because it isn't compliant, you move that to the US, that will still be a cost increase. And so we're adding more cost to the sector without generating any value.
What is the actual scenario, though? Because even when we talk about, trying to reshore or at least just shake up the supply chain, that could be a months-long, if not a years-long process. So what happens in the interim? They just sell fewer cars or what?
So first of all, you're going to push up pricing. You're going to try and put some of the pressure onto consumers to absorb this. You're going to eat some of this in your own margin, which is what we're forecasting. You're going to dock to suppliers and say, look, could you bear part of this burden as well? And you'll try to spread it out. I think the second step then is can you, in your existing supply chain, shift some production incrementally to mitigate the tariffs? But I'm very hesitant to say this will have a long-term effect. Because even for parts where, let's say, the labor content is just 10%, the labor content in Mexico is $5 an hour. In Alabama, it's between 20 and 30. And if you go to UAW plant in Michigan, it's $80 plus. So even with 25% tariffs, there really isn't a good reason to move manufacturing from Mexico into the U.S.
30 seconds. Top automaker in your coverage that can handle this the best.
I'll have to pick someone that actually isn't in our coverage today. If I look at the fundamental data, Tesla is positioned best. All cars made in the U.S., highest U.S. content in the cars, they will face the lowest tariff impact from all of this.
All right, Daniel, really appreciate it. Thank you for your patience. Thank you for being here. Daniel Roeska, Managing Director and Senior Analyst over at Bernstein. What I'm amazed about, Romain, is the volatility in the market overnight and this morning has led to a whole lot of nothing price action in the last couple hours.
A whole lot of nothing in terms of price action, but this is kind of the fear that you have to worry about. A VIX still elevated at that 48 level, and while the prices on the screen don't look like much, particularly compared to how low they were and at some point how high they were, the volatility in between, that's not healthy, Alex.
Nope, and the VIX still at 48, right? So definitely still elevated at that point. And a massive sell-off in the bond market. You got the 10-year ending the day at like up 19 basis points. We haven't seen this kind of move since 2022.
And of course, we continue our full coverage right here on Bloomberg Television of your market action. And of course, what drives that action, Romain Bostic here alongside Alex Steele. Scarlet Food now in the studio with us to help take us all the way to 5 p.m. here in New York. You just saw the bells and everyone clapping and ringing. An S&P down 0.2%, Scarlett. At one point, we were down 4.7%. At one point, we were up more than 3% on the day. The widest percentage point swing that we've seen on the S&P 500 in several years. A NASDAQ closing in the green, up about 0.1% on the day. Russell 2000 decidedly in the red, down about 0.9%, as is, Scarlett, the Dow Jones Industrial Average.
Yeah, pretty incredible moves that we've seen throughout trading, although the closing numbers don't really reflect that, right? I mean, it's kind of a ho-hum close when you look at these moves of less than 0.2%. But Alex, I'm so glad you brought up the move in the bond market, because what really amazes me is this flight to safety has not really played out. It's not materializing in the Treasury market, with yields moving up 13 basis points for the 2-year yield, 21 basis points for the 10-year yield, and gold also losing ground for a third straight day.
You sell what you gotta, not what you wanna, and that's kind of where gold plays out. And the question really being then for the Treasury market, is this going to be a full de-risking of U.S. assets across the board? That's the question.
All right, let's bring in Jason Pry, Chief of Investment Strategy and Research over at Glenmede. With a decidedly down day, with a few couple of blips there, with the NASDAQ, slightly in the green here, but decidedly another risk-off day to a certain extent, Jason. And the big question I have for you is, what brings people back into this market? Because you go back to about 10 a.m. Eastern time when there were those sort of, I guess we'll call them fake headlines regarding the potential for a 90-day reprieve, something that the White House immediately threw cold water on. But that led to a huge uptick in buying in this market, which seems to suggest that this is maybe, I don't know, a scenario where investors are willing to come back in if they do see maybe some sort of capitulation, not by the market, but by the White House.
Romain, I think your question's exactly right, because this is a market that has really encountered a good degree of pain. But after that pain, there's a couple of things that have happened. Number one is the valuations on the market have obviously come down to a better level that for investors, if we didn't have this circumstance, it would be considerably more attractive for investors to buy in, because upside appreciation would have that much more potential in the marketplace. But of course, we aren't through this situation yet. And so the second part of your question is not just about valuations. It's also about the actual trajectory or the path from here. And look, there's a couple of different paths here, right? One that's the primary worry in a lot of people's heads is a retaliation by our trade partners. We've already seen a little bit of retaliation from China, but an escalation of retaliations by other trade partners could make this situation worse. On the flip side, there's the potential for negotiation. And there's also a potential for a meaningful stimulus bill passing through Congress eventually. on that negotiation side, there's a pretty strong impetus for a number of nations to actually come to the negotiation table. The magnitude of their GDP being hit by the tariffs is actually higher than it is for the U.S. So the cards are actually on the table in a way that is admittedly stronger in the president's hands. It's difficult the way it's actually being conducted and the way these negotiations are occurring.
Yeah.
But the impetus is there for those countries to actually come to the table, which we see a little bit of a hint of.
Right. Well, we did hear President Trump say that the tariffs are a negotiation and also permanent at the same time. So put that into your earnings estimates. How do you value companies right now when you don't know what their earnings are going to be and they don't know what their earnings are going to be?
Now, at the end of the day, we think you need to think about companies from perspective of long-term earnings potential and recognizing that companies are dynamic in nature. They will find a way, ultimately, if you give them time to adjust, they will find a way to make profits in whatever environment you position them with. If that means a higher tariff environment, what we'll find is that companies will find a way to pass along some price increases. They'll find a way to onshore some of the manufacturing, and those earnings bases will ultimately stabilize. It is always difficult in times of stress for the market to actually see through that sort of plan. And it's also hard for investors to see the exact point of stabilization. But at some point in time here, the valuations become attractive enough that investors will be able to begin to look through it, particularly if we have a slowdown in the speed of the negative information and news flow that starts coming through.
So, Jason, everyone's going to be looking for those hints for when they can start entering the market. But in the meantime, if you need to hide out, what are the best places to hide out in?
Right. There's three areas in our mind. One area that's the obvious one is fixed income. Investors have been kind of given a little bit of a gift here with the rise in interest rates by the Federal Reserve and the rise in interest rates on bonds on the whole from about 5 years ago. Fixed income provides a reasonable yield and is actually showing generally a good degree of ballast in portfolios relative to equities. We've seen that through majority of the downturn. If you look at any given day, it might not show, but generally speaking, during the downturn, fixed income has held up better. Outside of that, within equities, there are two spots that really catch our attention. One is we do think that international markets provide an interesting ballast in portfolios. In a lot of cases, the U.S. dollar is actually slipping on this news, and international market and thus non-dollar denomination markets are actually holding up a little bit better. And probably the third area, which I'm going out on a limb here a little bit, is that small cap securities have hit an absolute low level in valuations. They may be the first items that are actually fully reflecting the vast majority of the downside here, unlike their larger cap brethren.
Yeah, that might end up being a brave call looking at small caps at this point. Jason, really appreciate your joining us. Jason Pride is Chief of Investment Strategy and Research over at Glenmede. Let's take a bigger picture look here and connect the economy to what we're seeing in the price action across asset classes. And for that, we want to bring in Torsten Slok. Torsten is Chief Economist over at Apollo. And Torsten, President Trump has again indicated over and over that he does not care about the stock market right now, but he does take comfort in seeing the 10-year yield come down, oil prices sink. My question to you is, how much does it matter if yields in oil are falling, but not for the best reasons? They're falling because people are pricing in a plunge in demand. They're pricing in a recession.
Yeah, I do think that we should worry about the downside risk for economic growth at the moment. Not only are tariffs going to have a negative impact on earnings over the next several quarters, but you also see corporate confidence is going down, consumer confidence is going down. We don't know what's coming on retaliation. Also, in addition to that, let's not forget the wealth effect that comes from wiping off $10 trillion off the market. And on top of that, we also have Doge still in the background, laying off workers in the government sector. So that list on its own is indeed quite a worry when you think about the outlook for the economy. But at the same time, also today, we did see rates go up. And the discussion around that you just had, why rates are going up, will become very, very important, because the rates going higher when stocks go lower, and also VIX basically moving sideways throughout the day, it tells you there's a lot of hedging activity going on. There's a lot of people that are trying to protect their portfolios, and that really only started in earnest today. And I think that's a very important backdrop for discussing what will happen in markets.
Is there any sense, though, that you can get a read-through into how people actually feel about the economic conditions there? You talk about the jump in rates, 20 basis points on the 10-year, Torsten, but I don't know how you or any of your colleagues in the economist world can even model anything out without having some clarity on whether the tariffs that are coming are indeed going to come, and more importantly, whether they're going to stay.
Yeah, you're right. And you also had Navarro say that there is no negotiation. That's also what Scott Bessent was saying. And that's also what Trump just said a few minutes ago. So if there is no negotiation, we should probably all assume that tariffs are going to remain in place. And maybe we can get some reduction. But if you now need to have 60, 70, 80 countries coming in and renegotiate and try to lower tariffs over time, it is absolutely right what you're saying, Romain, here, that this is going to stay in place for some time. And that's also why the impact on earnings is going to be negative over the next several quarters. And if, on top of that, the other factors, again, consumer sentiment, corporate sentiment, retaliation, lower stock market, it all argues for the spreadsheets that we all have for US GDP just pointing to more downside risk.
Sorry, so you're saying you see an earnings contraction afoot, Torsten?
No, I do think that the hit on earnings, it's very much debated how big the hit will be to the S&P 500. But I do think that absolutely the level of earnings, the E in your PE ratio, will absolutely be going down over the next quarter, simply because now companies need to figure out how do you respond to higher input costs? How do you respond to the fact that you don't know what output markets, meaning where you sell your stuff, is going to look like? So from that perspective, the uncertainty is going to weigh on top of the actual both higher input cost and uncertainty about output.
Right. So, Torsten, from that lens, do you expect the U.S. exceptionalism trade of the last 10 years to unwind and money flow out of the dollar, out of bonds, and out of stocks in a meaningful, sustained way?
No, I do not expect that, because what was really interesting about the move higher in rates today is that we actually, while rates were moving up, the dollar also went up. That's telling us that the sellers of rates is not foreigners. The sellers of rates are likely domestic investors. It's probably it could be just risk adjustment from people who are investing in credit and in equities that are adjusting now and selling the most liquid asset they have, namely treasuries, to try to cover and adjust their losses potentially on the risk side. It could also be potentially the basis trade that a lot of hedge funds, of course, have levered bets on, and the prime brokers businesses from the street, of course, supports this, that we will see significant deleveraging potentially when it comes to the difference in the price between futures and cash bonds. But we don't know quite what it was. But to your great question, I don't think it was foreigners today, simply because the dollar would have gone down if it was foreigners that were selling treasuries.
Before we let you go, Torsten, I got to ask you, when it comes down to signs of market stress, what are your best gauges of stress, of, a bigger problem that could be brewing, the disorderly kind of selling that we've seen at real lows in the past?
Yeah, I think this is a very, very important question. What I have is my Bloomberg screen up and the various windows. You should ask yourself the question, what I see in this window over here, for example, the sell-off in equities, is that consistent with what I'm seeing over in the other window here, for example, in rates, or for that matter in the dollar, or for that matter in credit spreads? And if everything is consistent, then you say, okay, these are markets that are orderly, this is behaving the way that it should. But when rates, 10-year rates today from the bottom went up to where they are now, basically almost 30 basis points higher, that is incredible, in particular on a day where stocks end up flat. Of course, I realize they were down, but the fact that VIX at the same time stayed elevated for the whole day, it tells you that there's a lot of hedging and protection activity going on. So the inconsistency between your windows is really ultimately what will tell you whether some markets are behaving normally what they should be doing.
All right, Torsten, we'll let you get back to work. I know you've been busy. Torsten Slok, chief economist over at Apollo, here as we take a closer look at the impact of tariffs on the economy and on the markets on a day where the market saw an incredibly wild ride, one of the most volatile days going back not just to the pandemic, and quite frankly, not just to the GFC. You really have to go back all the way to the week of Black Monday to see the types of moves that we saw on this Monday afternoon. And S&P, though, net effect, though, was only down 0.2%. The NASDAQ higher by 0.1%, while the Russell down 0.9%. Alex Seal will be rejoining us tomorrow. Scarlett and I will continue our coverage right here on Bloomberg Television as we talk about these big market moves, Scarlett. A market, of course, that started out the day, it looked like it was going to be bad. A drop of almost 5% on the S&P 500. And then around 10 a.m. New York time, we got some headlines about a potential reprieve from these tariffs. Headlines at the White House came out very swiftly and said they did not come from the White House. They did not come from Trump. There is no negotiation. We heard that from the president at that press conference with Benjamin Netanyahu. We heard that from Peter Navarro in that column for the Financial Times. And of course, the markets then had to find new footing here. And you see the numbers there on your screen.
Yeah, and all things considered, we have modest losses. Certainly, they are a third day of losses for equities, but nothing on the account of what we had seen earlier in trading. And in part, that's because investors are picking through the stocks and looking for potential winners. One potential winner, at least according to Citi, is Dollar Tree, the second biggest advancer in the S&P 500. Citi upgrading it to a buy, saying Dollar Tree has cover to increase its base price in this current environment because everyone else will be increasing their prices. On the flip side, if you look at MicroStrategy, which is now known as Strategy, it's become a proxy for Bitcoin, biggest decliner in the NASDAQ 100. It's going to register an unrealized $5.9 billion loss in the first quarter because it's adopting an accounting change that requires valuing Bitcoin, what it's basically become known as, at market prices. Now, our top story this hour really comes down to the market environment. Will selling pressure in the stock market force President Trump's hand? According to former JP Morgan strategist Marko Kolanovic, yes. And that's because despite Trump's insistence that he doesn't care about markets and their price action, markets lead the economy. Kolanovic says the Trump put is somewhere between 4,800 on the S&P 500, about 200 points lower than its current level.
All right. Joining us right now is Gennadiy Goldberg, head of U.S. rate strategy over at TD Securities. We're talking a lot about the Trump put. Is there a Fed put here? Because we had a market earlier, or at least overnight, I should say, there was pricing in 5 rate cuts for this year. Now, they've dialed that back a little bit here. Do you think we're going to get any sort of meaningful move by the Fed this year?
Yes, we do. I mean, we do expect them to actually start rate cuts at the June meeting.
Mm-hmm.
We've actually pulled that forward from July. We expect them to go to 2.5% by early next year. It is a little bit late. If you look at what's been happening, normally the Fed would be much more responsive to some sort of market shock like this.
Mm-hmm.
They're basically telling us they're going to be a little bit behind the curve, and that's okay.
Yeah.
But they're going to try to make sure that inflation's not getting out of hand. But they will start to ease policy. This is a big financial conditions shock.
But that's what I'm curious about, is how you square the circle. There's no doubt this is a big financial shock. But if you believe the inflation shock is also going to come, then how does the Fed justify lowering rates in that environment?
Well, unfortunately, they've already pulled out the transitory word. Really wish they'd put that away.
Yeah, me too.
But if we use a different T word, temporary, right? If there is a temporary one-time price shock and it is contained and it doesn't actually filter through into consumer expectations too much, we know it already has, but if it doesn't filter through into market expectations as well, I think that's enough for the Fed. They've already pointed us towards market inflation expectations. Your inflation swap curve is already showing you a pickup early and then a drop off after that. In about 2 to 3 years, you're not expecting a sustained price shock. So the Fed can kind of look through it, make sure nothing goes wrong, and then actually deliver the stimulus it needs.
That may be the case, but you have consumer inflation expectations showing something completely different. So which set of inflation expectations matter more?
I think markets, to be quite honest. Certainly consumer expectations matter, and I think it matters a lot. But if you start to dig into consumer inflation expectations, one of my favorite charts right now is looking at the Michigan survey, one-year inflation expectations by political party. You have Republicans expecting 6.5% inflation, Democrats expecting 6.5% inflation, Republicans expecting just about zero. One of those or both of those are probably going to be wrong. But it's hard to see exactly what the expectation is. If you look at markets are very cleanly telling you this is a 1 to 2 year price shock, and then we expect it to go back to normal. Again, assuming that what we expect plays out.
So the Fed is very data-driven. They've said that over and over again. And of course, they're at risk of being behind the curve because they're so data-driven. The data won't immediately reflect the impact of tariffs for a while. And when they do, it could be really messy. I keep reading magazine articles about how people should stock up on things before prices go up. So there's going to be a lot of buying of goods in the next couple of weeks or maybe even months before the real impact of tariffs take hold. How do you sift through that messy data?
Very carefully, I would say. And it's already been showing up. You saw it in Q4. You actually started to see it in early Q1 as some of these realities of trade really came to the forefront. You already saw folks stock up on essentials. You saw auto sales actually really start to rise as well. Very carefully. And the irony is, initially, the data might actually be a little bit stronger. And I think that's something to look through. I think the Fed is very aware of that consumer sentiment to pull that forward. But look at consumers as a whole, especially look at high-income consumers who've been vastly underestimated, driving a lot of this move in growth over the last couple of years. They've just suffered a really big shock to their wealth. I can tell you, I was out for a walk yesterday. The number of people around me, just in my neighborhood, talking about stocks completely unprompted was shocking to me. That tells me, those top 20% who are doing 40% of the spending, they are probably concerned. And if we get more days like we did in the last couple of days, that's going to be a big problem.
Yeah, I just want to bring a headline to the attention of our viewers. This is on Broadcom, AVGO, announcing a $10 billion share buyback. Of course, the stock that was down something like 38% from its all-time high. So again, with this big drop that we've seen in market valuations, maybe an opportunity for some of these companies to put some of their cash to work to try to shore up their prices. You're seeing those shares higher in the after-hour trade by about 4%. But Gennadiy, I do want to go back to something you said about the Fed and its potential reaction. A little bit earlier on this program, we had Bill Dudley on the program, formerly of the Fed, who talked a lot about this idea of what would actually get the Fed to react. He was of the mindset that, look, unless we get to a market-based sort of Lehman-style, Bear Stearns-style contagion risk type of market drop, that the Fed won't sort of react solely based on market activity. It would still look to economic conditions, inflation, the job market, et cetera. I just want to get your thoughts on that, because even though the sell-off that we've had over these last 3 sessions and really last 3.5 weeks or so, it does not even come close to what we saw back during the Lehman crisis, certainly not the GFC, or even going back to 87.
Well, the interesting thing is you made this point that actually the moves we've seen in the last couple of days have been more reflective of Black Monday, right? If we continue to have that kind of move, we'd be very close to all-time records. What we don't know is what breaks, right? The financial system is an agglomeration of people doing certain trades, leverage trades. Torsten earlier was talking about basis trades. All of that can come unwound very quickly when there's a massive shock to sentiment and to equities, to rates as well. I do think that the Fed will need to see real data. I mean, that's the reason we don't expect the Fed to cut in your meeting. We don't expect them to cut in May. We do expect them to wait just a little bit, watch some of that early data, try to get a sense of what consumers are doing, and then actually start to deliver a little bit of easing.
Gennadiy Goldberg, really appreciate your joining us. Fantastic insight here. Gennadiy is head of U.S. rate strategy over at TD Securities. And of course, continuing the conversation on how this all shakes out for the economy, how the Fed proceeds, how policymakers move forward, let's bring in Alan Blinder. He is professor of economics and public affairs over at Princeton University, and of course, the former vice chair of the Federal Reserve. Professor Blinder, thank you so much for joining us. When I think about how people are characterizing the economy in 2025, at the start of the year in January, the soft landing narrative was dominant. That kind of slipped away, and people started talking about stagflation in the last couple of days and weeks. Recession now appears to have replaced stagflation. Is that the default outlook right now?
No, I think stagflation is the default outlook right now. And I don't think people were talking about it until a few days ago. At least not many people were talking about it until a few days ago. And we know exactly why they're talking about it now. These gigantic tariffs, which Trump announced larger than almost anybody thought, certainly larger than I thought, are stagflationary. That means they raise prices and they depress quantities. Quantities like real GDP and consumer spending and investment spending and so on. We have rampant uncertainty, rampant fear in some quarters. I hope the relatively calm ending today to a very volatile day in the markets will calm some people down, but I don't know. We'll have to wait and see.
We'll have to wait and see. And of course, the Fed is standing by, waiting and seeing as well. How does the Fed proceed? How does it communicate its patience to the market?
I think for the very short term, mostly by being quiet. If things get worse again, you may have a kind of a calm down speech from Jay Powell or somebody like that. But, he's got in the back of his head, if I start saying, calm down, people may think there's really something to worry about. So I don't think they want to say very much. I'll tell you the one thing apropos of that notion that the Fed was going to cut rates 5 times this year. I never thought that that made sense unless the economy really goes to hell. But what I'm really sure about is that Jay Powell doesn't know now. He's watching. The whole Fed is watching the data to see what happens both on the price front, how much inflation are we going to get from these tariffs, and on the quantity front, how much will job creation go down, how much will GDP go down, if it goes down at all. That's not known for sure, but it seems to be a reasonable bet right now.
Is there a case to be made in the here and now, Alan, about the potential for systemic risk from some of these market moves, that there could be instability bubbling up again, under the surface, that the Fed should maybe intervene sooner than later rather than waiting for the more traditional economic metrics to show any sort of pain?
Well, you can always make that case, yes. I mean, I won't say no to that, but I don't think they will. I think the main thing that they're looking at is to figure out whether this is going to be worse on the price side, that is, damage their campaign against inflation, or worse on the quantity side, that is, damage GDP and industrial production and employment and all of those things. At this point, nobody knows. If I were to make a guess, but it's only a guess, and I'm glad I don't have to act on it.
Yeah.
It would be more like 50-50. One goes up, the other goes down, in close to equal amounts. But that's just a guess, and the Fed's not going to act on a guess.
All right, Professor, I have to ask you something a little bit more academic, and this really goes back to that seminal paper that you wrote back in, I think it was 2007, on offshoring. This is a White House right now that has made it clear that it wants to see more manufacturing here in the U.S. And there are a lot of naysayers that say that just can't be done given just the general economies of scale here. You warned about the risk of offshoring so many of our jobs. You updated that research in 2010, saying that things had gotten even worse. And I am curious as to how you look at that long-term trend of offshoring, where it's brought us today, and whether realistically that can be fixed in a meaningful way by trying to bring those jobs, that manufacturing, that economic activity back inside the U.S.
Well, let me start backwards. The fixing it will be very, very difficult. This is a result of very powerful forces of various sorts, the most obvious of which is the tremendous wage disparity between what Americans earn, and we want them to earn high wages, and what Vietnamese workers earn, and Thai workers earn, and Chinese workers earn. That's still there. One thing that's gotten lost, and I haven't heard anybody mention this, not that I've been glued to the television set all 3 days, that manufacturing as a share of output in the United States has not really declined. What's declined is manufacturing as a share of employment. Why is that? Because American manufacturers have gotten so much more efficient. Some of it is robotics, some of it is other things, but they don't need as much labor to produce the volume of manufactured goods that they did 10, 20, 30 years ago. That's not a bad thing. That's a good thing. And we don't want to get rid of that.
We don't want to get rid of that, but is it reasonable that tariffs might bring back some of those actual manufacturing jobs to the U.S. And not bypass the robotics, but in addition to the robotics, that there might be a meaningful increase?
It could be. It could be. But if that was his objective, these tariffs would have been targeted at one or more specific industries or types of work, not across the board. When you start doing across the board tariff increases, it looks like either, it's probably both, an expression of anger, let's kick the world in the face, and or changing the currency value, basically, for goods transactions.
So
not the kind of thing we're used to over the decades, protectionism for some particular industry.
So the tariffs fulfill multiple goals by the Trump administration, not only to bring manufacturing back to the U.S., but also to raise revenue that will be offset by extending the tax cuts. how meaningful will that revenue that's likely to be raised from these tariffs be? I know that these are moving targets because there may or may not be negotiations on the tariffs, but have you done any work on that or seen any work on that that convinces you this is a meaningful move in the needle?
I've not done any work. I've seen some work. And, it depends what you mean by a meaningful movement of the needle. A little bit. It won't be zero unless he starts raising tariffs to 100% and things like that. I just saw something about going up another 50% on China, which would put us nearly 100%. Hopefully that won't happen. What he seems not to understand very well is that the more they protect American jobs, if you want to call it that, the more they keep foreign goods out, is what it really is, the less the tariff will bring in terms of revenue. We're still not that import dependent, although a lot is being made of it. We import amounts to like 1/7 of GDP or something like that, not 5/7 or 6/7 or anything like that. And that will shrink because of the tariffs. And so the idea, for example, that I've heard out of the White House, that you might be able to replace the income tax by tariff revenues seems fanciful in the extreme.
I am also curious, too. I mean, we talk a lot about this in the context of just what the U.S. is doing without necessarily taking into account the potential for retaliation. And a big part of what the Trump administration has articulated is the idea also of trying to weaken the dollar. Of course, the dollar's strength is relative to, of course, the strength and weakness of foreign currencies. What is the logical argument that this path that we're going down right now with regards to tariffs would have a meaningful depression on the U.S. dollar?
Well, usually we think of tariffs as something that boosts the dollar because Americans are buying less abroad. In this case, I think what he's doing is shattering confidence in the American economy. If you were, let's take some neutral country, if you were a very rich person in Singapore or someplace like that, would you want to be sending money to the United States these days? You used to want to. I mean, it was coming in droves from all over the world. But when you have this kind of erratic behavior, even nonsensical behavior out of the White House, that is clearly anti-foreign. Nobody can miss that. It doesn't make America a very attractive place to send your money. And if that happens to any substantial extent, that's going to drive the value of the dollar down.
I want to kind of circle this back, and we only have time for one more question, Professor, about just the impact on kind of regular folks. I mean, we talk on this program about what's going on with the markets and to a high level, obviously, with big investors, institutional investors, high net worth individuals. There are a lot of people out there, as some of our other guests have pointed out, that were just inundated over the weekend by comments, questions from people that don't normally follow the markets. I know I was on the receiving end of a ton of that. Small businesses, people looking at their retirement accounts and wondering what the heck happened over the past couple of weeks. What do you tell them?
Well, first of all, that the stock market is volatile, and don't assume that what it did yesterday is what it's going to do tomorrow. Secondly, in the long run, if you can hold out, now some people can't hold out for the long run, but if you can hold down, the stock market tends to eventually shake these things off and come back higher than ever. That doesn't mean it's going to happen next Tuesday. So the other thing I tell people if they ask me, I don't go pushing this, is it's not usually a good idea to sell into a panicky falling market. Wait a little. But the last thing I want to say really is that quite a few Americans, especially at the lower end, let's say the lower 50% of the income distribution, don't really have that much stake in the stock market. Yeah. If the economy holds up, and that's, of course, their danger. But if the economy holds up, the fact that the stock market fell 12% or whatever is the right number is not really going to hurt them very much.
All right, Professor, it's a great place to leave it. Really appreciate you taking time for us. Professor Alan Blinder over at Princeton University and, of course, former vice chair over at the Federal Reserve. And, of course, his last question is the big one. We talk about the impact on the economy, if there is one at all. Global tariffs, though, they are threatening to raise costs. They're threatening to squeeze profit margins and ultimately to boost inflation. If you're a small business or a medium-sized business, the question is, can you absorb that shock? We're joined right now by two small business owners. They run a chain of restaurants. Pinky Cole Hayes is the founder and CEO of Slutty Vegan, and Derek Hayes is the founder and CEO of Big Dave's Cheesesteaks. I'm pleased to say that both of them join us here in Studio 2 once again. It's a pleasure to see you both again, although I wish the circumstances were maybe a little bit more favorable. I do have to kind of ask you about kind of this shift in, let's just call it, economic perceptions over the last few weeks and months, and what type of impact that might have on your customers or potential customers. Are they still spending money? Are they willing to come in and spend on something that for a lot of people is discretionary?
You know, it's interesting because now that we're dealing with all of this, the topic is, do we raise our prices, right? A lot of my products are made in the United States, but ingredients are sourced overseas. So if they raise those prices, then, you know, it'll be more money for me. And then I have to charge my customers more. And that can affect the consumer experience because people are consistent with one thing and then they have to go to something else. It really compromises it. So it gets a little difficult, but we're just trying to navigate.
In terms of your ingredients and the other supplies that you have, which ones are most exposed to potential increase in tariffs?
Well, I would say you with your burgers. For me, is what I wrap the sandwiches with, the foil wraps, you know, stuff like that. You know, when it comes to foam, paper, all those things we would have to, you know, get the consumer to pay more money for, which, you know, that's the last resort you want to resort to.
When you talk about raising prices, how much of that is kind of depending on whether your competitors do that too? Because obviously you don't want to be the first one out the door to do that. But if everyone else is doing it, it gives you a little bit of cushion and room to do that.
Sometimes you don't have a choice. Like for me, I just purchased my company back. So, you know, I don't have institutional money like I used to, right? So like it's coming out of my pocket. So now the decisions are different. So I'm making decisions based on how much we can afford as an organization. And that gets very difficult, right? We get it done, but it gets very difficult, especially because I'm in a genre that's not really large. You know, Derek sells cheesesteaks for a living. I'm in the vegan market. I sell vegan food. So like I am the comp. You understand what I'm saying? So being the comp, I have to make the decisions and most people follow suit based on what I do. So just being really strategic in that is just very challenging.
How much visibility do you have then, Derek, into the cost of your supply? I mean, maybe for right now, but do you have it, you know, 3 months down the road, 6 months down the road?
Hopefully it is 6 months because for me, I'm franchising, so my franchisees got to be able to make the money hit their mark. So there's a lot of pressure on me right now. I just had a grand opening last Saturday of Vito. Was a massive success, but the whole time thinking like, you know, the economy is strong right now, but how is it going to look later on? Like when it comes to my walk-in coolers, when it comes to my grills, when it comes to my hoods, all these things that I have a set cost on, and I kind of could tell the franchisee, you know, this is what the cost is going to be, but now we don't know because of what's going on with the tariffs.
Have you made any attempt, or do you even have the ability to maybe try to front run some of that, meaning buying a lot of that equipment before you actually?
Actually, I had a meeting last week with Avanti. We're doing some partnership things together, and hopefully that company will allow me to help me set my prices, you know, where it's affordable for the franchisee. But what hurts right now is the not knowing what it's going to look like, being a small business versus the national chains with a bunch of spending dollars. So we're fighting against the odds.
And I think one thing that's even bigger than that is we're working on Haines Hospitality. So for the world who don't know, this is my husband. So we have a hospitality house, right? So I sell vegan food, he sells cheesesteaks. But we realize, you know, as we continue to grow and scale, we have to be able to pool resources and come together. And that's the only way that we can win. So with Haines Hospitality, we can get more equipment at a cheaper price, you know, if we buy 10 at a time versus buying 1 or 2 at a time.
I'm not sure what your labor staffing looks like right now, but given the unknowns, would you be comfortable doing any significant hiring?
Well, I have to do some hiring just to get some new talent, but we have to be super strategic in the talent that we hire. Like, we can't just put bodies in position. Like, we really have to make sure, because one, it costs us about $1,600 every time we hire somebody. So we want them to stay. So when we do bring them on, we have to make sure that it's the right talent, they have a good resume, they got a good attitude, and their ethos is aligned with the business, because if it's not, we're just spending more money.
Yes, I agree.
Is it harder to find the right people then in this environment, or is it maybe easier because people feel nervous and they want to put their best foot forward?
Well, I actually think is a lot tougher because if you go all the way back to when the economy crashed back in 2020 when COVID hit, a lot of people got used to, the dollars coming in, the economy changed, nothing changed for us, but, we're paying higher payrolls right now and higher build-out costs. So it hurts us as a small business right now, all the way around holistically.
People want to get paid more. I mean, that's the name of the game. Things are more expensive. Inflation is high. People need to live and they need to sustain themselves, rightfully so. So it does make it a little bit difficult.
I have one more question for you, Go. I mean, you kind of alluded to this a little bit earlier that, we've had you on before when you were building Slutty Vegan. You lost that business at some point.
And I just bought it back.
And you got it back in a relatively short period of time. I mean, we only have about a minute left, but I'm curious as to exactly what happened there. Did you use that because of something you did, or was it more because of what your investors did? What happened there?
There's a bunch of variable elements, but the moral to the story is we had to do a global restructure, and the best businesses in the world go through global restructures. And as a result of that restructure, I won a bid to buy my company back, something that I know is so very special, and I know I have a great product. So now I'm in the process of raising funds again and continuing to scale my company internationally.
You're trying to raise funds now in this environment.
I am in this environment.
I assume that's harder than maybe what you.
It's terribly tough. It is terribly tough. Okay. But this is my PSA for whoever's watching this. Okay. But the reality of it is, I know I have something great, and I know it'll continue to be successful with the right parties.
All right, fantastic stuff. Pinky Cole Hayes, thank you so much, founder and CEO of Slutty Vegan, and of course her husband, Derek Hayes, founder and CEO of Big Dave's Cheesesteaks, and of course they are launching Hayes Hospitality as well this year.
Thank you.
All right, let's take a look at how markets closed on the day, because the closing numbers are really not going to show you the wild swings that we saw. High volatility because of this ongoing trade war. Stocks, bonds, commodities, everything affected. The S&P 500 down 0.25%. The NASDAQ up 0.2%. Feels like nothing, right?
It feels like nothing. And look, you did see some bids come into some of those big cap tech stocks, which is a big part of the reason why you saw the overall indices up. But still, the majority of the stocks were lower. 341 stocks in the S&P lower. And it gets to this idea that if you are coming in to buy this dip, Scarlett, what exactly are you going to buy?
Yeah, and how long are you going to have to wait to see it pan out?
Actually said she expects an earnings contraction for the S&P 500 this year.
Yeah, well, we know that analysts are definitely sharpening their pencils and bringing down those estimates for earnings. This is The Close on Bloomberg. Headlines sparking volatility across the board. Jonathan Levin writing that America's retirees will soon share in Wall Street's pain. He says President Trump has said his reciprocal tariff policy was meant to stand up for the American worker. But even if these policies improve the lots of workers, and I really doubt it, the efforts are already coming at the expense of American retirees. Jonathan joins us now. Jonathan, a lot of this is due to data that show older Americans own most of the stocks outstanding.
Yeah, they absolutely do. And look, I just think it's very cynical and myopic if people think that they are going to burn down the U.S. stock market for the sake of reshoring some manufacturing jobs. Maybe I'm being a little hyperbolic here, but let's face it. 1 in 2 Americans thinks that they're going to fund their retirement out of 401k accounts. 1 in 3 existing retirees is already depending on a retirement account with equities in it to fund their retirements. How is that strategy fair to them?
Yeah, I don't know. And Jonathan, it gets to the question, too. I mean, we talk about people kind of in that middle income spectrum that could be hurt by this, particularly if you are at or near retirement age. But also, want to talk about some of the wealthier people, because I know we kind of dismiss that and say, OK, well, they'll be able to weather the storm. But I've seen some interesting economic numbers that have sort of taken into account how much of a drop you get in the stock market before wealthy people kind of pull back. Doesn't mean they don't have the money to spend, but certainly not the psychology or the willingness to.
Yeah, exactly. And look, Romaine, I think the fact of the matter is the populists in government want to make it out that Wall Street is doing one thing and Main Street is doing another thing. But that is not how the U.S. economy works, right? Wealthy people own the businesses. Wealthy people spend less when they see their portfolios plummeting, and all of these things move downstream to the working people that the administration administration's policy is supposedly trying to help. And so, I think that we have to be very attentive to what's going on with the wealth effect here. We have a lot of data suggesting that strength in retail sales over the past 1 to 2 years have really been powered by those wealthier people. And let's face it, if they retrench, that means a lot fewer service jobs in the here or now. Maybe the expectation is that those people will get jobs in the factories of tomorrow, but you're talking about a long slog in the meantime.
Yeah, well said. Jonathan Levin, another great column, our Bloomberg Opinion columnist down in Miami, as we continue to focus in here on President Trump's new policies and the ripple effects in markets and the economy. The president spoke just a little while ago saying there would be no pause in tariffs, and in fact said that right now he doesn't even see them as a negotiating tactic. Terry Haines joins us, Pangaea Policy founder, to talk a little bit more about this. And Terry, I do want to kind of zero in on this idea of the tariffs being a good negotiating tool. The president said explicitly that's not necessarily the case. Peter Navarro just wrote a column in the Financial Times saying that's not necessarily the case. The idea here that there is a long-term plan, if you believe that they're trying to execute, that may mean 2 to 3 years of economic pain. Are you buying that?
Well, what I'm buying, Romaine, is at root, and I won't argue with the fact that the White House doesn't communicate well or particularly consistently. But what I'm buying at root is what they want is negotiations that ultimately bring all tariff levels down for the ultimate benefit of the American economy. I could point you to a couple of countervailing things Trump said in that same press conference. And Navarro's always out there doing the Navarro thing, but I'll take Trump over the weekend, some of Trump today with Bessent, Lutnick, and even Musk. And then I think you kind of see the direction they're going in, generally speaking.
So, Terry, will the growing chorus of critical market voices move the White House in any way? We're talking Bill Ackman, Stan Druckenmiller, Larry Fink, even Jamie Dimon, if you read between the lines of his annual shareholders letter. Or does the president turn on them for calling out his policies?
Well, I think certainly that Wall Street chorus backfires on the people that say they want changes in strategies and tactics. What I draw from it is a few things. One is that they were kind of late to the post. In Washington, if you're silent, you're actually assenting to whatever's about to happen. So I think they weren't in there heavily and strongly enough to begin with. And now what you're seeing is a lot of CYA, frankly. I think beyond that too is that you get a situation where them asking for changes and asking in one case for Lutnick to be fired, I think, probably just stiffens Trump's resolve in the other direction. Trump's doubled down on a lot of things, but one of the things he's doubled down on is the idea that you got to stay the course, and that's been crystal clear even throughout your coverage today. So I think that doesn't redound to their benefit. No.
Do you have a sense, though, Terry, and I know this is just your gut opinion, that the people in his orbit right now, meaning the cabinet members and other policy advisors, are willing to stay that course? And I ask the question because there's already been speculation about a couple of people I won't name who might actually be looking for the door already.
Oh, I think they stay the course. Yeah. In one case that I saw, by the way, the report that one of those people was going to leave was being thrown out there principally by MSNBC and in the New Republic, which are about the last two sources that are going to have inside pipes into the Trump administration. So no, I mean, look, these folks signed on for the entire ride, and they're going to be here for a while.
Terry, very quickly here, what's your take on the bipartisan bill in the Senate to limit the president's ability to impose tariffs? Is that going to, I know it's not going to pass, but what does that do in terms of how it affects the White House's policy moving forward?
Well, it almost certainly doesn't pass or even come close to it. You're absolutely right about that. What it does is indicates that there are a number of people that are willing to put some more pressure on the president to actually push in the direction of negotiations and lower tariffs. And then in most of these cases also, politicians are frankly trying to insulate themselves against negative effects in their own states. And I don't blame them for that. You got to do that.
All right, Terry, appreciate you taking time for us. Terry Haines, he's the founder of Pangaea Policy. Of course, policy front and center for financial markets, and we saw that in a big way with the volatility all day long.
Yeah, and of course more to come because as the president has made clear, he doesn't want to negotiate on the tariffs, but he is open to discussions, so that perhaps means leeway in other directions.
We should point out the VIX remains volatile, though we should point out the close at the end of the day for financial markets not quite as bad as what we saw in the intraday. You are watching The Close with Romaine Bostic and Scarlett Fu.